Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leverage and Jeffrey Holst pour out old fashioned real estate advice.
Episode 9.
Good afternoon. My name is Brian Leverage.
And my name's Jeffrey Holst.
Welcome back to the Old Fashioned Real Estate Show. It's good to be with you again today. And we're here to talk about another topic that is referred to as leverage. And no, I'm not talking about me, even though it is something I enjoy doing.
But we did have an episode about that, and if you look right above my head, you'll see a link to that episode if you want to find out more about Brian Leverage.
But really, this leverage is much more important. And what that
I would agree with that, actually.
And what that is essentially leverage is using debt financing or borrowed money from some other entity or person to assist you in the purchase of an asset.
That's right.
Yeah.
And why would someone want to use borrowed money?
Well, it increases, you can buy more properties than just using all cash.
So like if you had $20,000, you could buy a $20,000 property, or maybe you could
Buy
put a $100,000 property.
Yeah, absolutely. And more importantly, it increases your return on investment, which I know you're going to kind of get into here now.
Sure. So, there's definitely a potential to increase your return. I wouldn't say it does, because if you borrow at a rate higher than the return on the investment, it's not going to increase your investment. But if you can borrow at a lower rate, it definitely can increase your, I would say, almost supercharge your returns.
Sure. So why don't you give us an example of
Sure.
what that looks like?
So let's say you're buying a quadplex that nets, let's say it's $200,000 and it nets $20,000 a year after all expenses. Okay, so that's a 10% return on investment.
Yeah.
Which means if you were to take $200,000, you're going to get $20,000, right? So that's pretty similar. You know, that's maybe a bit of a stretch, but it's, I think, doable in this market. So if you have this asset, that the return on the asset is 10%. So if we move to a leveraged position, say we borrowed 50% of the money from the bank. So
$100,000.
Yeah, so I go to the bank and I say, hey, bank, I'd like to borrow $100,000. I'm going to put $100,000 of my own money in. And they say, great, that sounds great. We're going to take a mortgage on the property and whatever, but we're going to have to charge you some interest for borrowing that money. And let's say that's 6%, which I think is a safe number. What would the interest on $100,000 would be $6,000 a year.
$6,000. That's interest only, which just for illustrative or
right.
purposes.
There's going to be some amortization costs, but that's still money that you get.
Yeah.
So from
you're
the,
still paying $6,000 in interest.
So you're paying $6,000 in interest. And that means your net operating income is still going to be $20,000. You're going to pay $6,000 of that in interest, and you're going to have $14,000 in some combination of amortization and also cash flow.
Sure, but you're now making $14,000 off a
$100,000
investment, which is a 14% return on investment.
Right.
Which is better than
10%.
Sure.
So that's called return on equity, right? So the what you've done is you've increased your return from 10% to 14% by borrowing $100,000. And you could take that a step further if you wanted. You could borrow 75%. So maybe you borrow $150,000 still at 6% interest.
Which means you're at $9,000 interest.
Exactly. And your net income after expense for interest goes down to $11,000.
Yes, proportionally.
Right, so it's $11,000 on now a $50,000 investment.
We've gone from 14% putting $100,000 down to putting, $50,000 down, and we're now making 22% on our money.
Significantly better return.
Right.
Now, of course, some people might say, but wait a minute, I was making $20,000 and now I'm only making $11,000, so I'm actually out $9,000, which is technically true, but
you'd also have another $150,000 invested.
Or
on an all-cash basis. Yeah.
Or if you didn't have the extra $150,000, you were able to get in for $50,000 instead of buying a $50,000 property that makes $5,000 a year. You're now making $11,000 a year.
Also a great point.
Yeah. So the point is that by using leverage, you can really increase the returns that you get from the investments that you're making.
Right. It's really important when you take on any type of financing to look at both sides of the coin, because leverage is really a double-edged sword. So while it magnifies your return on equity, it can also have the opposite effect.
If
right?
you end up losing money, it can be really bad. So one example would be like in our quadplex, if maybe the neighborhood gets worse, or maybe I have a tenant that trashes a unit.
High operating expenses.
Yeah, something changes. So my income either goes down or my expenses go up. So now my net operating income drops to, I don't know, let's say $8,000. So it cost me $12,000 more, whatever happened, right? Well, in that case, if I'm on an all cash basis, I put $200,000 down, I make $8,000. It's like a 4% return on investment. It's not great, but it's still probably better than I'm getting at the bank.
Yes.
So that's something, right? But the problem with it is if we're using leverage, right, and we were using that 50% down, now we're getting $8,000 and we're spending $6,000 in income.
That's not good.
Right, in interest costs, right? So now we only have $2,000 net. Well, still, I mean, $2,000 on $100,000 invested now is a 2% return. So it's not great, but it's probably like, CD rates, right?
Yeah.
So I'm still okay. But what if I was using 75% leverage?
You'd go negative.
Yes, I would, because the cost would be $9,000 in interest, and I would only have $8,000 in income. Now I'm losing $1,000.
The math won't work on that for very long term, right?
Right. Well, and of course, there's also probably amortization costs in there, so I'm actually going to be losing out of my pocket even more than that. Another thing that could happen, and this is both an advantage and disadvantage of leverage, is that the price of the asset could change. I buy it for $200,000, it appreciates in value to $300,000. I've made a 50% gain on my investment. If I'm using leverage though, and
and it falls by $100,000.
Well, if I'm using leverage and it goes up, it's really great, right? Because maybe I put $50,000 down, it went up $100,000. Instead of making a 50% return, I just made a 200% return on my equity. But the opposite also applies. This is, I think, where you were going with it.
And the big takeaway is this. You want to be conservative whenever you're looking at taking on any kind of debt financing. The higher the loan to value, in other words, the more money the bank lends you, the more you're increasing your risk on that particular investment. And there are people that operate at higher leveraged amounts, and there's people that prefer lower ones.
And the banks are going to limit some of this too for you. I mean, they're going to look at your total financial picture and they're going to say, we're only going to loan, 80% on this particular property because we feel like that's, where we're comfortable. Or they might say 75 if you're a riskier borrower, or 70 or 50. Or if you're in a particular market where maybe you're doing a redevelopment, they might give you 90% of the cost. But there's, and of course the banks also look at other things other than just what's called loan to value, which is really what we're talking about.
Right.
They look at things like your debt service coverage ratio, which is, what the
probably a good episode.
Yeah, we'll make an episode of that, and when I do, I'll try to tag it in the video here. But the short version of the debt service coverage ratio is that they're going to look at the cost of financing, whatever the amortization and interest costs together are, and they're going to want you to have income that's at least that much plus something.
Right. Usually 1 1/4 is the
pretty typical
general ratio.
Which means if your cost of borrowing is $20,000 a year, they're going to want you to have $25,000 a year in income, because they want to know that after all expenses, you're going to have some money left over. Yeah. Because the truth of the matter is, and this is I think what you were saying about being conservative in your leverage, is that it's great if you have a property that makes $20,000 a year, but if it falls to $8,000, it can be really bad. And the banks know that when they're looking at the debt service coverage ratio, that sometimes things will happen that are unpredicted, that will change the income. And so they want to have a cushion there that really helps you. And of course, that's good for investors too, right? When we underwrite deals, we're always looking at the debt service coverage ratio. And a lot of times we want something that's better than 1.25 because we want to feel even more secure in our debt.
Yes, the higher the better.
Yeah, sure. I mean, I would love it if it was like 1 million times, but it's probably not going to happen.
But 2 is pretty good.
Yeah, 2 is pretty good, or 1.5 is actually pretty good. I feel very comfortable when I get in that 1.35 to 1.4 range. And on some deals, you look at it and the nature of the deal is such that a lower ratio might make sense, right? Especially if you see it as a long-term appreciation play or something like that.
Yeah.
So I think that pretty much covers the reasons that people would invest using leverage, and some of the risks that leverage might, you might accrue by using it. And me personally, I'm a big fan of both leverage and leverage.
Yeah.
So, and by the second leverage, I mean leveraging my real estate. I don't actually mean you, because you're kind of weird.
And something else to keep in mind too, just as an add-on to all of this, is that we are still in what is generally considered to be a historically low interest rate environment.
Right.
And so with borrowing costs being in that low range historically, it does make sense to take advantage of situations like that if you can. And again, if you've mitigated your risk and really underwrote the deal and done so in a way that fits your investing thesis.
That actually brings up one more risk point that I don't think we covered, which is actually, I think, worth thinking about, and that is there is an interest rate risk involved, right? If you leverage, then you're kind of stuck with leverage until you pay it off. So if you borrow 75% at 6% and 5 years later you're in maybe a balloon situation where you have to refinance and rates are now 10%, you're going to borrow at a higher rate.
Yeah.
Or you might not even be able to refinance if we happen to be in a recession or something.
Or property values decline, et
right.
cetera.
Yeah. So there is some risk to leverage that you need to think about when you're using it. But again, the potential to supercharge your returns, get a much higher rate of return, has the potential to make you so much more wealthy that we would still recommend you do it, but just make sure you're conservative as you do it.
It's whatever you're comfortable with in the long run. We just wanted to give you this advice for today. We thank you for joining us, and we'll see you again soon. Cheers.
Cheers.